Look at one price that refuses to act normal. On January 2nd, 2026, silver printed about $74.46 an ounce. That is a level most people link to stress, not comfort. Yet the latest headline CPI for November 2025 shows 2.7% year-over-year. Two meters disagree. Watch the contradiction. Metals often move like a confidence meter. Consumer baskets move like a cash flow meter. When those meters split, stress is usually in plumbing, not in the checkout line. Now watch this. Notice what makes this episode louder than a simple silver up story. Rates are not at zero. The Federal Reserve's policy ceiling sits at 3.75%. And the Fed's daily rate table showed the 10-year Treasury near 4.18% and the 30-year near 4.84% at the start of January. Yet silver still surged. Check the rhythm of past breaks. In the early 1930s, Britain suspended gold convertibility under external pressure. In the late 1970s and into 1980, silver exploded in a crowded move, then collapsed. In the late 2000s, credit cracked and policy filled the void. Different eras, same lesson. Markets price regime change early. That's when the pattern matters. Calm data, chaos underneath. Follow the money into the first mechanism. The debt engine. A system can carry debt when refinancing is cheap and trust is high. But a large debt stock turns small rate changes into huge interest costs. Think of an adjustable mortgage on a giant house. The house does not change. The payment does. Look at what shifted after the crisis era. Household leverage cooled. Fred shows household debt near 68.8% of GDP in the second quarter of 2025. But the public balance sheet expanded. Fred shows total public debt near 118.8% of GDP in that same quarter. The load moved upstairs. Notice why the upstairs load changes the risk. A household defaults when it cannot pay. A sovereign that borrows in its own currency can roll, tax, or dilute. Investors price those options. Metals respond when dilution starts to look like the path of least resistance. Here's the catch. Check a quick checkpoint. The system did not erase the debt problem. It redistributed it. Redistribution changes who controls the next move, and it changes who feels the pressure first. Watch the second mechanism hiding in bond math. Term premium. Term premium means the extra yield demanded to hold long bonds instead of rolling short ones. When that premium rises, it says trust costs more. It is like a landlord raising the security deposit. Rent is one thing. The deposit reveals anxiety. Notice the third mechanism, real yields. On that same early January rate table, the 10-year inflation indexed yield sat near 1.93%. That is a positive real return. Metals usually struggle in that backdrop. So why does silver still run? Hold that question. Look at the key idea in plain English. A metals rally is not always about low rates. Sometimes it is about the future supply of currency versus the future supply of real output. In a moment, the answer will connect metals to everyday prices. That's the tell. Follow the money into velocity of money. Velocity is how often each dollar turns over in the real economy. When velocity is low, liquidity can sit in accounts and in portfolios without pushing up bread and rent. Fred's M2 velocity printed around 1.406 in the third quarter of 2025. Notice the analogy. Think of a stadium with closed gates. People can pile up outside with tickets. Concessions do not sell until the gates open. Low velocity is the closed gate. It keeps a lot of liquidity from turning into broad price pressure. Watch how this creates a divergence that feels unreal. Metals can reprice the unit of account. Meanwhile, oil, wheat, and shelter can stay calmer for a while. That does not refute the metal signal. It often marks the phase. Stay with the sequence. Check what keeps phase one alive. A large share of wealth sits inside financial assets, so cash stays parked. If portfolios become a source of cash instead of a warehouse of cash, velocity can rise. Keep that image. It comes back. Notice the promise. Stay for 3 warning signs that decide slow grind versus sudden snap. Look at the bridge between phases. It is not one scary headline. It is behavior. People spend faster when they expect prices to rise faster than wages. Firms front-load orders when replacement costs climb. That behavior turns one price move into many price moves. Watch the wealth channel as a potential trigger. If equities stop acting like a storage unit for liquidity and start acting like a source of cash, selling can unlock spending power. Picture a dam releasing water. The river downstream does not rise 1 inch at a time. It jumps. Check another checkpoint. Metals up with calm CPI is not nothing happening. It is often phase 1 happening. The real question is simple. Does behavior shift? If it shifts, phase 2 can activate. Follow the money past one border. The dollar is the global invoice unit, and that makes US funding choices everyone's problem. Institutions like the IMF and the BIS track how dollar liquidity and debt interact across borders. When the base currency wobbles, the hedge demand can show up first in metals and long bonds, not in local CPI baskets. Look at how reset usually arrives. It rarely shows up as one announcement. It often shows up as a new rule of the game. It can be a different policy reaction. It can be a different funding method. Or it can be a different tolerance for inflation versus recession. Notice the cliff edge. If long yields keep rising while risk assets roll over, snap won't be last. Check the calendar, because the system publishes stress points on a schedule. 3 dates sit directly ahead as public checkpoints. January 9th, 2026 brings the employment situation for December. January 13th, 2026 brings the CPI for December. And Treasury lists the next quarterly refunding document release, scheduled for February 4th, 2026. Watch what matters on the jobs release. The question is not good jobs or bad jobs. The question is whether hiring cools while wage pressure stays firm. That mix squeezes margins and shifts policy language fast. Notice what matters on the CPI release. The November CPI showed 2.7% year over year. But the Bureau of Labour Statistics warned that October survey data were not collected during a federal shutdown. That is measurement risk. Markets treat the next clean read as a credibility test. Look at what matters on the refunding release. Quarterly refunding is where the US Treasury communicates borrowing needs, auction plans, and debt management posture. When buyers demand more term premium, the long end becomes expensive. When the long end is expensive, choices narrow. That's when the countdown starts. From now to January 9th is the first gate. From January 9th to January 13th is the second. From January 13th to February 4th is the third. Markets often front-run the gates because positioning happens early, and it gets tighter. Check the policy constraint that can turn calm into reset. The Fed can cut short rates if growth weakens, but long rates can refuse to follow if investors fear dilution. That is fiscal dominance in plain language. Funding needs start steering the curve. Follow the money through a simple curve example. When the 2-year yield sits near 3.47% and the 10-year sits near 4.18%, the curve is not pricing a boom, it is pricing time risk. If the curve steepens because long yields rise, that steepening is stress, not relief. Look at how metals behave in that setup. Gold often tracks credibility premium. Silver adds an industrial layer. It can rise on manufacturing demand and on currency hedging at once. 2 crowds can push one door. The door jams either way. Notice a third checkpoint. Debt load, term premium, and low velocity can coexist for a while. That is how calm surfaces form over stressed foundations. One more twist. Watch for the 3 warning signs next. They decide whether phase 1 stays contained or spills into phase 2. Look at sign 1. Metals up while long yields also rise. That says hedge demand and time distrust at the same time. Notice sign 2. A naked break-even inflation turns up even if headline CPI looks calm. That implies markets expect higher future pricing pressure than the current prints show. Check sign 3. Credit spreads widen while equities stop making new highs. That combination says risk is repricing in the funding layer, not just in headlines. Result? 1 warning light can be noise. 3 lights together suggest system strain. Strain forces decisions, policy pivots, funding adjustments, or a repricing of risk across assets. This is not prediction. It is a template for reading the tape. Follow the money back to history for the rhyme. In 1931, the break started in reserves and credibility. not in supermarket aisles. In 2008, the break started in credit spreads, not in wage contracts. Plumbing first, street later. Notice the modern twist that makes data feel calm. November's 2.7% CPI headline came with unusual caveats because October data were missing. When measurement gets noisy, markets lean harder on prices that trade every day. That is why metals can feel ahead. That's when the pattern matters. Calm data, chaos underneath. Look at how the signal can travel without showing up in CPI right away. A currency can lose value against hard hedges while still holding value against a specific basket of goods for a period. That happens when goods supply is improving, or when spending is weak, or when wealth is parked. Metals do not wait for the basket. They price the unit. Watch the difference between inflation and devaluation. Inflation is a broad rise in prices paid today. Devaluation is a drop in the currency's promise over time. Devaluation can appear first as higher long yields and higher hedging demand, even when inflation prints look tame. That is why the curve and metals often move together at turning points. Notice where the system can try to contain the leak. Policymakers can lean on communication, on regulation, and on liquidity tools. Banks can tighten lending. Firms can cut costs. Each move can slow velocity. But each move can also expose the debt constraint, because slowing growth makes rolling debt harder. The system trades one risk for another. Check a fourth checkpoint. If metals stay hot while credit stays calm, the system is still in a market-only phase. If credit begins to widen while metals stay bid, the stress is moving from hedging into funding. That is when resets stop being abstract and start being operational. Follow the money to the practical meaning of reset. A reset can be a new policy mix. It can mean looser short rates with tighter fiscal choices. Or it can mean tighter credit with more direct support. It can also show up in plumbing changes like bill issuance choices. The point is constraint, not drama. Watch the silver detail that complicates the signal. Silver is both money metal and input metal. That dual role can amplify moves. A small hedge bid can collide with steady industrial demand. When inventories run thin, the price reacts fast. That speed is why silver often feels like a siren, not a gauge. Check a fifth checkpoint. If the warning signs stay split, the system stays in slow grind. If the signs align, the system moves into decision mode. Decision mode is when policy language changes first, then behavior changes. Notice the recap bridge. Debt sets the constraint. Term premium prices trust. Velocity decides timing. Silver is the flare that shows the wiring. Look at the 3 dates again, because repetition is part of how markets work. January 9th, January 13th, February 4th. Those are the next public prints for labour, inflation, and funding posture. In a minute, the dashboard will summarise what matters most. Check the dashboard before the close. Fed policy ceiling, 3.75%. CPI November 2025, 2.7%. 10-year yield, early January, 4.18%. Notice what those 3 lines mean together. Policy is lower than long yields. Inflation prints contained, but the print itself had caveats. And metals are not acting contained. That gap is where resets begin, if they begin. The next gates decide whether behaviour changes. Watch the second countdown, because narratives flip fast in tight windows. January 9th, January 13th, February 4th. Markets can front-run them, then reprice them when the numbers land. If the warning signs stack, the response can be quick. Notice what does not matter most. Daily chatter about targets fades. The system reacts to funding, wages, and velocity. Those 3 decide timing first. Look at the flare one last time. Silver above 74 is not a guarantee. It is a stress signal. It says someone paid up to move currency risk off the table. The next releases will show whether the stress stays in markets or leaks into daily life. That's when the pattern matters. Calm data, chaos underneath.